The third area, a big area, is retirement accounts. And not all retirement accounts are created equal. They're all different. And the most obvious ones are things like 401ks, 403bs. If you're in higher education or healthcare, you might have a 403b plan, or if you're a teacher. And 457 plans if you work for a municipality or state. There's all different kinds of plans that are all considered pre-tax plans, okay? What that means is during your working career, you have made a contribution to your retirement plan, such as a 401k, 403b, 457, and the like. All of that money is going in on a pre-tax basis. So if you make $100,000 a year and you have contributed $10,000 to your retirement plan, then you're only taxed on $90,000 a year. That is a pre-tax contribution, okay? What does that mean for you from now until retirement? All that money is going to grow tax deferred as well. You're not getting a 1099 like I mentioned before on the brokerage accounts. You're not getting a tax statement every year unless you take a distribution from that plan, okay? Different pockets of money, right? We're talking about brokerage accounts, which are liquid and accessible before 59 and a half. There may be some tax consequences associated with that, which are taxed mostly at capital gains rates, but you have more control and flexibility over those accounts, versus retirement accounts, which are tax deferred vehicles, generally cannot access them without a penalty until age 59 and a half. Every dollar that you take out of that account at now or in the future will be taxable as income to you, okay? Not as capital gains rate are generally lower than your income tax rate. So two different tax situations. But retirement accounts don't provide as much liquidity for the short term, especially if you're younger. So you have to contemplate, okay, if I'm receiving money in retirement accounts, I know that I can't touch that really until 59 and a half without a 10% penalty. And at some point when I spend that money, I'm going to be taxed on every dollar of it. Okay? So that's things to consider. But it's also a great tool for you to build your foundation for the future so that you do have a clear path of maybe a plan for retirement at some point, someday. Now, there's also Roth IRAs and Roth 401ks. Different taxation, different buckets of money, and also should be contemplated and clearly divided and done in a different way than your pre-tax money. A Roth IRA or a Roth 401k is different in the fact that every dollar that you put into either a Roth IRA or a Roth 401k has already been taxed. So in that same situation that I used, when you make $100,000 a year, you're putting $10,000 into your 401k, regular, pre-tax, that's reducing your taxable income today. With a Roth IRA, it is not reducing your income today. You are not able to deduct a Roth IRA contribution from your taxes today. However, that contribution and those funds that are invested in your Roth will grow tax-free, meaning you won't get a tax 1099 every year, definitely the same way. You still have limitations on accessing this money. It's a little bit different. Your contributions can be accessed based on current tax law if you've had the account for 5 years, okay? Because basically you've already paid taxes on that money, so you can get the money back without having a tax penalty. However, there are stipulations. And of course, tax law is subject to change at any time and all times, and it's one sure thing that always happens is that the tax laws will change. But difference is when you have Roth proceeds in retirement, you're not taxed on those distributions as long as you're 59 and a half. You can access that money with zero tax liability. So again, different tax situations, different tax considerations. How are we dividing everything? Are we dividing the Roth assets and the pre-tax assets separate from each other, or are we lumping it all in? Okay, so different considerations for those two pots of money.